Welcome back to another episode of Multifamily. Our next guest is Shana, the tax goddess. Welcome, Shana.
Oh, thanks so much for having me. I get to talk about one of my favorite subjects, taxes. So I'm very excited to be here. Thank you.
Awesome. Thank you. And a little bit about Shana. Shana, tax goddess, is a highly sought after certified public accountant and founder of Tax Goddess Business Services, PC, established in 2004. Tax Goddess is a global team of 93 plus specialists that uses plain language, not tax code, to help business owners, investors, and entrepreneurs create plans of action to increase the business owner's bottom line, reduce costs, significantly reduce taxes, increase cash flow, and perform what if scenario option so that owners know what decisions to make and which paths are best suited to their particular situation. So, with that, Shana, you want to add anything to your background?
Oh my goodness. Well, I suppose it's a question of what you want me to add. I started in astrophysics. I've worked for the Big Four. I've got two best-selling books. You name it. What would you like to know? And I'm happy to tell you.
So, what makes you shift from astrophysics to this side?
So the very long story short is I am definitely a mama's daughter. Okay. My mom is my world. She's my goddess. And I started off in astrophysics, came home from college, and she had gotten a notice from the IRS. And the downsides to being a redhead, that made me very angry, right? That my mom got a notice. I was very upset about that. And so my mom was talking about she went to her tax attorney, she went to her tax accountant. Nobody could help her figure out how to reduce her taxes. And I suppose the benefits of being an astrophysicist, right? I was pretty good at numbers. And I said, well, maybe I can figure it out. And it started the path. And so here we are 25 years later. And I'm now in the top 1% in the country for tax strategy. So it's all thanks to my mom. So.
Awesome. Thank you. So, maybe most of my audience will be in real estate, multifamily space. So, exactly, how can real estate investors take advantage of tax deductions or credits to maximize their returns?
Absolutely. So, I think one of the biggest things that real estate people in general miss is that there's, of course, the basics, right? Are you active? Are you passive? Are you a real estate professional? I'm sure your audience has heard that 50 million times. We have some newer things that have come out over the past 10 years, Airbnb, short-term rentals. There's two main things that people seem to miss. One of them is that if you have a business, which investing in real estate is a business if you treat it like a business, right? So you may have staff, you may have an administrative assistant, you may be using your car to drive around, you may have cell phone bills, things that apply to all of your rentals, right? This is a business. Now, you do have to have income to have a business. So be looking for property management fees, consulting fees, how do we create an actual business? But the mere fact that you have a business now allows you to write off all of the same deductions that a business owner can get. So things like paying your kids, writing off your dogs as security, using the master's exemption on your personal home to hold education events. So there's a million strategies that are accessible if you're properly structured to have an actual business. The IRS looks at rental properties as, you have one property and you gain that income, you have the expenses, but not necessarily as a business unless you're treating it as a business. So step one, make sure you're actually treating it as a business. You're properly set up as a business. You've got a separate LLC for the business management, all of these pieces. And then secondly, once you have a business, if you need an office building for your business, you can actually get cost segregation for your office building if your business is in your building, even if you don't meet the real estate professional status. It's a fifth category of writing off cost segregation. Of course, active and passive, typically you get limited, but with real estate professional, short-term rentals, or if your business is in your office building, that's a fifth category that you can use cost segregation without matching the real estate professional status. So those would be the two biggest, most common strategies that I see missed by most real estate investors.
Got it. Thank you very much for sharing that. So let's say if new investor started, investing business. So initial few years, they may not get enough cash flow, but they might have good expenses like, attending various conferences, educational events, or coachings, other expenses, right? Marketing. So how is it that they can structure that?
Yeah, so and it's really interesting the pieces that you pulled out there, because the cash flow on the property, again, the IRS looks at these things as two very different pieces. So the cash flow on the property is very specific to the property, right? You got the rents, you paid the mortgage, you paid the property taxes. Those are very specific expenses to the property. If you want to be able to write off the education, the conferences, you know, the travel, the food, like whatever it is to go do that, that's where you need that business. But you have to be able to prove that you have actual income for that business. So, for example, what a lot of our, you know, we set them up as property management companies. If you are doing your own property management and you receive a payment, you better prepare a 1099, right? That's what tells the IRS that I'm moving money from one to the other to create a proper business, right? You have to treat it like a business. So separate bank accounts, separate credit cards, you know, you don't commingle your property with your business, these kinds of things. So lots of options on what you can write off, but the structure itself, we generally will recommend an LLC for the business itself. Having an LLC also allows you to take advantage of other tax strategies, like, for example, a medical reimbursement program for you, for your family, for your kids, your spouse, your grandparents, whoever's helping you work on the real estate business. So having that LLC as far as structure tends to be the right choice in 80% of cases. So.
Got it. Thank you. From apartment in the investing point of view,
Mhm.
so they may not own a like property management company, but they might get some, fees like acquisition fees, other asset management fees, something like that. In that
Yep.
scenario, how exactly they can structure?
Well, that'll help as well. So any type of income that is different than the actual rents itself, right? So if you're being paid, if I understand your question properly, let's say you're helping hunt down a property for other investors, right? So you're being paid an acquisition fee. That would work, right? That's a different kind of revenue. If you are in fact a real estate agent and you are closing deals, that would help, right? That's a different type of revenue. So really the IRS just wants to make sure that your rental income is showing on your rental forms and your other business income is showing up on the business form. So.
Got it. Got it. Sure. So can you walk us through most common tax challenges for real estate investors?
Yeah, so I smile because the most common challenge is not even really a tax challenge. It's more of a documentation challenge. For many of us, we start getting into real estate, and way, way, way back in the day when I was still doing astrophysics, I owned 8 single families and a small commercial strip. Okay. And back then, before I got into tax, I didn't really realize, I mean, I knew that I should do documentation, but I really didn't understand the level at which documentation is really proper, right? And if, heaven forbid, if you get an audit, that they're going to come look at it. Okay. So I think the biggest challenge that we see is people say, oh yeah, I'll put together my mileage records at the end of the year. No, you won't, right? Go and download MileIQ on your phone, okay, and do it while you're doing it. Okay. We see people say, yeah, okay, so I'm going to do tax planning, but I'm going to wait until December 1st. By December 1st, you're kind of done, right? Like the banks are closing, everything is shutting down. It's very difficult to look at alternatives. Especially when we see real estate, there's the beginning of the journey in real estate and there's the end of the journey in real estate. And depending on where you are in that timeline, if you're just getting into real estate, you have tons of write-offs that you can do within the real estate realm, right? Set up the business, do the cost segregation, you pay the kids, lots of options getting into real estate. When you're ready to get out of real estate, right? So we're not 1031ing real estate to real estate, right? But you're ready to get out. Maybe you're older and you're ready to get out of real estate. You don't want to manage or deal with anything anymore. You want to move into real estate investment trust, right? More passive source of income, something like that. In some cases, there's huge tax bills to pay. You've been taking depreciation for years and years and years. You have depreciation recapture. So looking at alternatives to real estate, things like maybe offsetting a little bit of your investment with oil and gas or solar, conservation easements, which is still real estate, but not a piece of property you own. So really deciding which strategies you need for which time period in life you're in is one of the most important things you can do.
Yeah, good points. And also like, insurance side, life insurance or some annuities, those also.
Absolutely. And how do you use the life insurance? You brought up one of my favorites. How do you use the life insurance to pay the bill for the tax property that you support? Right. So one of my using life insurance to its maximum capability instead of just having life insurance as life insurance. So yeah, knowing how to use it as a tool.
Yeah, yeah. So in your experience, how exactly real estate professionals stay informed about changes in tax laws, regulations, so that impact their businesses, like, bonus depreciation, like last few years or something like that.
The topic everybody wants to cry over, and we're all hoping we get 100% back, right? We want our 100% deduction. Yeah, you mentioned one of them, right? Conferences. Talk to people, join organizations. Many states specifically will have real estate associations where you can go and learn these things. Now, of course, follow experts. Okay, listen to this podcast to learn the most up-to-date news. These kinds of things. When you work, I think one of the biggest things that we see. So we are what's called a tax goddess, is what's known as a tax strategist. We are not a tax CPA. So we don't file tax returns. Our job is to come in, work with your CPA to help come up with strategies. Okay. Now, often, your CPA becomes kind of the oh, excuse me. I'm getting all worked up about this, all the good bits. Your CPA becomes the hub of information. And really, that's fantastic. If you have a CPA, a tax preparer that knows real estate, specializes in real estate, that's a good thing. But most tax preparers don't have the time or the bandwidth to stay on top of things like current court case changes, the law that just changed, the BOI change. Do we file, not file? What's going on, right? All of these changes. And so really that's where a strategist comes in. The job of a strategist is to be at the forefront. New news, what happened today, what court case happened today that will impact the decisions you're making before December 31st. So.
Got it. Thank you. That's very good information. So what are some strategies for passive investors to maximize tax efficiency through depreciation, cost segregation, or other methods without having to actively manage the properties themselves?
I was about to say, so my poor little passive people, I love you guys, okay? Because passive is just one of those it's a hard thing to do. Now, when we talk about big picture, okay, the IRS allows passive to offset passive, active to offset active, and ordinary, so real estate professional, to offset W-2, for example. So if you are passive, if there's no way you're going to meet active, certainly no way you're going to meet real estate professional, really what you want to be looking at, of course, cost segregation is kind of your easiest first step. Now, that is not going to offset other income. Okay, it's only going to offset whatever income you have from your rental properties. So if you have 5 rental properties making $500,000 a year of rental income, and you can do cost segregation, it will offset the rental income you have, but that's it. It won't go above that. Now, if you have done cost segregation, there's nothing left to segregate, right? You don't have any new properties. The next thing to do would be look at, again, alternative investments that are specifically passive. So, for example, diversifying into oil and gas. Oil and gas can give some amazing tax deductions. And if you like oil and gas as an investment, can also give income from oil and gas. But with oil and gas, you can pick active or passive. So if you need passive losses and you have passive income, you can offset oil and gas, as an example, against your passive real estate income. So, most people, when they talk about real estate at a passive level, if they can get to zero, they're happy. I mean, that's as far as you're going to get. Passive just will not offset anything else. So most people are trying to fight for, well, how do I at least make it active? And the most common thing that I hear, to be honest with you, is how do I get my spouse to quit their job and go become a real estate professional? Okay. And if I had that magic wand, I'd be making billions. Okay. It's very difficult to convince the spouse to quit their job. So, yeah. So.
How about like investing in oil and gas and energy sectors? Will that affect offset like active income also?
It can. So for example, if you have some passive income, your real estate, and you have a W-2, right? You can invest some money into the passive side in oil and gas and some money into the active side. So you actually have two separate investments in oil and gas. But I always kind of use oil and gas as the easy one that people understand. I really like to look at the world as a world of alternatives. Okay. So you could invest in real estate, you could invest in oil and gas, you could invest in solar, you could invest in tribal credits, you could invest, I mean, there's a million different things to invest in. And I think one of the things that always comes back to me is that you have to be happy with the investment, right? Because if you don't like oil and gas, don't invest in oil and gas, go invest in solar. If you think that's the future, go invest in solar. So really when we as strategists come in, one of the most important things that we do for people is to understand, well, who are you, right? What do you care about? If you prefer oil over solar, fine. What about your kids? Do you want to leave something to them? Are you trying to build an empire? Is charity important to you? You know, are you taking care of aging parents? Right? Do they have medical expenses? So when we look at tax strategy, even though we're very focused on a specific industry, right? And we do work, 40% of our practice is real estate. So we've got another 60% that does other things, right? But you know, when you look at a specific industry, you're really, there's about 1,800 strategies that we look at as tax strategists for every single case. So even though you're in this specific industry, there might be something at the personal level, 2-3 things at this other business, you know, there's always other options. And tax strategy is really about how those options play together to get you the best bottom line. So
Perfectly said. Yeah. So, what are some most effective tax strategies for high net worth individuals, investors? So, looking to minimize real estate taxes and capital gains on inherited properties, or something like that.
absolutely. Well, let me segregate that, because in my mind, those are really two distinct things. So one is we've got a high net worth, high income earnings. So maybe you've got a W-2 $1 million, you have 2 or 3 rental properties, but you're single, you're certainly not real estate professional, right? Like you're doing whatever you're doing with your W-2 job. So one of my favorite strategies, 2 of them really, the tribal credits I mentioned. Another one is something called the SOP. It involves some Forex trading. Okay, so again, a lot of these alternatives, right? What other ways can we look at? Now, if you're speaking specifically about real estate and getting out of the real estate, because you said capital gain, right? So now I'm done. I want to get out. Okay. Of course, you have 1031. Right. And that's a very common, well-known, and certainly we can cover it in detail if you want, but there's 1031, there's 721, which is taking real estate and going to a more passive investment, still in real estate industry, right? But more passive. Of course, we have opportunity zones for another year, maybe. We'll find out if that gets extended or not. So we have opportunity zones. There's also a variety of types of trusts that you can use. So an installment sales trust, IST, there's a CRAT, there's 16 different CRTs, there's 16 different versions if you're interested in the charitable side. And then of course the SOP, you know, some of these other alternatives, because some people decide, you know what, I don't want to go do charity. I'm just not interested. I've already done enough charity. I don't want to do more. I want to keep the money for my family. Okay, so let's go look at some of these other options. So again, a lot of it really depends on how much of a capital gain you're trying to get rid of. What I can tell you is that if your capital gain, the amount you're going to pay tax on, whether it's depreciation recapture or just the gain itself, if it's less than about $200,000, there are strategies, but those strategies might cost more than they're saving you. And it's one of the pieces that we as strategists really look at very closely. You know, there's no point in me telling you, yes, go do this strategy. It's going to cost you 60 and save you 40. Why? I might as well just pay the tax at that point. So very often we come back to who are you? What do you want? Which areas do you want to be invested in? Those kinds of things. So,
Yeah, got it. Thank you very much. And for investors engaged in 1031 exchanges, so what are some common pitfalls that can result in unintended tax liabilities, and how can they ensure they are fully compliant with IRS regulations throughout the process? And also, like, how exactly they exit from the 1031s,
Absolutely. Okay. So I love it. Big questions. I love it. Okay. So first things first, a 1031, I have seen too many examples cases where somebody says, I don't need to pay an intermediary. I'm going to do it myself. Okay. The one piece of it, if you take anything away from today's podcast, okay, you pay the professionals the fee to do what they do. Okay, there's a reason that they charge a fee, and whether that's tax strategy, 1031 intermediary, whatever. Okay, a lot of the pitfalls that I see are because people try to do it themselves and they miss something. The 1031 regulations are actually fairly complex. They seem simple, bought a property, sell a property, get a replacement property. Seems very simple, but if you don't check this box, if you don't file this form, if you don't do this in the proper order, if you miss your replacement property times by a day, you're done, right? Everything is done. You will pay capital gains tax. So I'm a big fan. Strategy number one is hire the right professional team, because that can mess you up. Now, of course, getting out of, so you had a 1031, but you can't find a replacement property. You've looked. This is something we're seeing a lot of right now. Have a replacement property, but everything out there is overpriced. I'm not getting a deal. I don't want it. It's a bad neighborhood, like whatever, you're just not finding the deals that you want. That is when you go look at these other strategies, right? So should we do the SOP? Should we do tribal? Should we do oil and gas? Because really what you're looking at that point is the money is going to hit your tax return. What other things can you do on your tax return to get rid of it, right? To legally put it somewhere that's more beneficial for you and your family.
So can we do like from real estate to oil and gas and solar side also?
Unfortunately not in a 1031 specifically, right? So 1031, I think it was the end of 2018. 1031 was very specific. It's property to property. It used to be that you could do anything to anything as long as you rolled the game, rolled the money. But that disappeared. So it's real estate to real estate only. Now you can't, the 721 is the only other thing that acts like a 1031, but that's real estate to investment in real estate, right? So more like a partnership, investment into a partnership, okay? Everything else means that you will receive the capital gain, but you're using other strategies to reduce the amount that's taxable. So it really just becomes a question, and I'm so sorry that I keep going back to this, it becomes a question of what do you want? Like, what do you want in your life? Do you want 90% of your portfolio in real estate? Okay, if you do, then 1031 is the choice, or 721, one of those two. But if you look at your portfolio or your overall asset allocation, and you're saying, geez, I mean, I did really, really well in real estate, but 90%, what if it tanks? Right? Like, let's get 40% and go do some in oil, some in solar, some, let's diversify a little bit. And so I suppose maybe I would call that one of the other mistakes that I see people make is you made a lot of money in real estate. And I love real estate myself. I've made a decent amount in real estate, right? I like real estate, but am I going to put all of my money in real estate? No, it doesn't. To me, it doesn't feel very safe. And that might be the conservative CPA in me coming out. So, yeah.
Sure. Thank you. Thank you. So what's your focus next, 2 to 3 years?
Next 2 to 3 years, strategy, pure strategy. I mean, anytime we have regulation changes, anytime we have tax increases, and I understand that our soon-to-be president is talking about tax reductions, but somebody has to pay for it at any point in time, at some point, right? So I'm a big fan, especially on structure, right? So family partnerships, how do trusts get involved? You mentioned life insurance, how do we use life insurance to build empires? And really just making sure, for me, my big personal push is getting strategy out to the world. There's only in the entire US, there are 660,000 CPAs, right? And CPAs do all sorts of things. There's only 60,000 that have masters in tax. So this is where we start to, really specialize. There's only 15 that do what I do, which is the super senior specialty tax strategy stuff. And so, many people just don't even know that there's a difference between your regular day-to-day CPA who's preparing your return and a true tax strategist that is looking at all of the pieces, your life insurance, your financial, your trust and estate, everything, right? And so I think if I could say anything is my goal for the next 2 to 3 years is to get that knowledge out there and to help more people. So yeah.
Awesome. And good luck with that. Sure. Any personal habits that are helping you to be successful?
Oh, good sleep and eating well. Those are kind of it seems so simple, right? But if I don't get 8 hours, I'm a very cranky redhead to say the least. So yes, good sleep and eating well.
Awesome. So any books that impacted you?
Oh, I always have to go back to Tim Ferriss, 4 Hour Work Week. Okay, when I started my business, so as you said, my business started in 2004. I'm 20 years old for my business. And when I very first started, Tim Ferriss's book had just come out. And I remember reading a footnote about automatic scheduling, having a link. You know, now everybody has a Calendly link. But yeah, my favorite book still is whatever, The 4 Hour Work Week by Mr. Tim Ferriss.
Awesome. So how can listeners can connect with you, Shana?
We're super easy to find. So taxgoddess.com. You'd be speaking to my business development team and they will guide you through the process of what does it look like to work with a tax strategist. So I get involved way down the path when we're doing the super hyper technical stuff. And
Awesome. And thank you very much, Shana. Thank you.
thank you so much for having me. Such a pleasure.
Sure.